Your short call is getting run over. The stock is ripping towards your strike, and you're sitting there wondering, do I just take the loss or is there something I can do? Rolling is that something. And today I'm going to show you exactly how it works, when it saves you and when it digs the hole deeper. Hey, what's up? Welcome back to Chalk Talks with Coach B. If you're brand new to options, check out the Options Basics playlist first. I'll link it in the description because what we're doing today assumes you already know what a short call or a short put looks like. If you're solid on that, let's get into it. Drop your questions in the comments or come find me on the stream. I read all of it. All right, so what is a roll? One sentence. A roll means you close your current option position and simultaneously open a new one at a different expiration, a different strike, or both. That's it. You're not starting over. You're adjusting the trade you're already in. There are two basic directions you can roll. You can roll out in time, meaning you close the near-term option and open one further out on the calendar, giving yourself more room to be right. Or you can roll up or down in strike, moving to a higher call strike or a lower put strike to get out of the way of where the stock is heading. And a lot of the time you do both at once. Roll out to next month and shift the strike a little. The goal when you do this is to collect a net credit, meaning the premium you collect on the new option is more than what you pay to close the old one. When you do it for a credit, you're not just adjusting, you're getting paid to adjust. Let me walk you through a real example with clean numbers. Let's say you sold a $55 call on a stock trading around 52. You collected $150 when you opened it, and you've got about 2 weeks left, but the stock has moved. It's now sitting at 54.50, and your call is getting tested. You check the chain, and it costs you $285 to close that short call right now. Here's the roll. You close the 55 call for $285, and at the same time, you sell the 57.50 call out 45 days for $500 in premium. Your net credit on that roll is $500 minus $285. That's $215 coming into your account. So now what do you have? You've bought yourself more time. You've moved your strike up $2.50, giving the stock more room to stay below your call. And you collected $215 doing it. Not bad at all. Your new break even is higher. Your expiration is further out, and you got paid to make the adjustment. Now let's talk about when this works and when it doesn't, because rolling is not always the right move. Roll when you still believe in the thesis. If you sold that call because you thought the stock was going to stay range bound and nothing fundamentally changed, the stock just drifted up a bit, rolling buys you time and gets you paid. Roll when you can collect a net credit. Roll when you have a clear reason to believe the stock isn't going to keep running through your new strike before expiration. Now here is when you absolutely do not roll. Do not roll when the thesis is broken. If the reason you had for selling that call in the first place is gone, the stock is not range bound, it broke out hard, something changed in the fundamentals, rolling is just paying to delay a loss. The market doesn't care that you adjusted. If the stock is going higher, your new strike is going to get run over too. And never roll for a debit. If you have to pay to roll, meaning the new premium is less than what it costs to close the old one, you are writing a check to stay in a bad trade. That is how a manageable $200 loss turns into a $900 loss. Let me show you the downside scenario because this is the trap I see traders fall into all the time. Stock breaks out hard. They roll for a small debit to buy more time. Just $200, no big deal. Stock keeps going. They roll again for another $300, then again for another $400. Now they're $900 in the hole on a trade that started as a simple short call. Each roll felt small in the moment. Together, they became a disaster. This is what happens when you roll a broken thesis. You're not saving a trade. You're averaging down on a loser with premium risk layered on top. So the rule is simple. If you can roll for a credit and the thesis still makes sense, it's a legitimate tool. If you're paying a debit or you're just hoping the stock reverses, close the trade and move on, live to trade another day. That discipline is worth more than any single adjustment. Here's the checklist I run through before rolling anything. 1, is my original thesis still intact? 2, can I roll for a net credit? 3, does my new strike give me real room, not just a tiny buffer? And 4, would I actually enter this new position fresh if I didn't already have the old one? If the answer to any of those is no, I close it. That's the mindset. Don't let a losing trade become a bigger one just because adjusting feels better than taking the loss. Rolling is a tool, not a rescue plan. Use it when the setup earns it, collect a credit when you do it, and know when to walk away. Quick reminder, This is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. That's it for today. If this helped, smash that like and subscribe and drop a comment with what strategy you want me to cover next. I'm always looking for topic ideas. Good luck in the markets, no matter what stock you're into.